we had Access Bank finally release its half-year results, and generally the reaction to that was good. The stock was up 4%, and just looking at the numbers, we saw that it's pretty much in line with what we've seen from the banking sector. Gross earnings are down about 13% compared to a year ago, and of course PBT is up 14% compared to a year ago. However, when you look at it on a quarter-to-quarter basis, there are some things that I think some investors might want to be asking about when the bank has its conference call tomorrow. Things like the non-performing loans ratio, which has come up to about 12% from 9%, which it was at for the first quarter. Now, non-performing loans obviously brings up the issue of risk management in the banking sector. And joining us in the studio today to look at how far the market has changed in that regard is Michael Ogunbiyi, who is a director at CBO Capital Partners. Thanks a lot, Mike, for coming onto the program. So let's start, like I mentioned, we're looking at risk management in the banking sector. Where were we before now, and what were the obvious problems before, obviously, the central bank had to intervene in the market?
Okay. I think essentially the central bank audit revealed that the sector was prevalent with lax risk management practices and corporate governance structures. Mm-hmm. This in turn led to the erosion of capital bases. Between post-2007, based on CBN's regulations, a number of banks went out to mm-hmm. invest in risk management manuals, enterprise risk management frameworks, right. To be developed. Unfortunately, what seems to be the case is that most of them didn't actually go as far as implementation. This is accentuated by the fact some of them even went as far as producing risk numbers, mm-hmm. Measuring the amount of risk being taken and so on, but that didn't actually lead to decisions being taken as a result of these figures. Right. I mean, essentially, when one measures risk, it should actually be for a specific purpose, to tell mm-hmm. you how risky your exposures are, mm-hmm. Which markets you probably should divest from, and which ones you should go into, right. As well as essentially formulating part of your investment decision and strategic decision making as an organization. Mm-hmm. We also have to look at the fact that there was major growth in the markets post-2006, post-consolidation essentially, where people essentially focused on dynamic growth and essentially the league tables, as opposed to investing in risk management, as opposed to investment in risk management structures, in the appropriate people, and so on within the industry. Right.
Okay, just sorry to interject there, but let's now look at where we are right now. What has changed? Obviously, we know the regulators have made some changes in prudential guidelines. From what you've seen in the marketplace, can you point to major changes that you... Obviously, we know that in a crisis situation, there will be a lot of risk aversion, but what are the obvious changes in risk management in the banking sector now?
I think, sort of to reiterate what you're saying, I mean, the risk aversion is prevalent right now. We are in crisis. There is a credit squeeze. People aren't necessarily going out there to book a whole lot of risky assets, mm-hmm. Which generally is the drive for the banking sector. Mm-hmm. This is not the case at the moment. Now, based on the fact that aggressive risk provisioning is necessary, as mandated by the central bank, it means that banks are being a lot more careful. Now, really, because we are in financial sector, if we take the nine out of the 24 banks where there was an intervention from the central bank, it's going to be very difficult to see where they are. I mean, some of them appear to be having better figures in terms of less non-performing loans, mm-hmm. Some growth in some areas, and certainly far better than they were at the end of 2009. This being said, what will be essentially very telling is once we come out of crisis, to see if the reforms actually stay, if the structures stay.
Okay, let's be a little more specific now. What else do you think needs to be done? Which were the critical areas that we still need to see some change and perhaps need to be addressed right now?
I think essentially placing risk management...
Are you satisfied in general with where we are?
Again, that's I'd say probably not so satisfied at this stage. Yes, we are making strides in the right direction, and that is down to central bank's mandate and their guidelines to the banks in terms of how one operates maybe under margin trading or how a bank should operate. I mean, it's still, for me, very early days. There's apparently going to be a dismantling of universal banking. essentially making banks focus on their core competencies. Now, of course, with that, there's going to be a hell of a lot more changes in the banking system. That is going to force, that certainly will force banks to be a lot more prudent in what activities they undertake.
So you're saying we really have to just wait and see?
I think we have to wait and see what can people do to make sure it's in place, is improve upon governance structures, ensure risk management is placed at the right level, begin risk measurement and using those risk numbers to drive the strategic and investment direction of the company.
Okay. Now let's, once again, I have to be a bit more specific. For an investor going into these banks right now, what are the signs that they should look out for in terms of an institution that has that proper framework in place?
I think essentially the level of disclosure coming out of the banks. I mean, in a number of parts of the world, it is actually possible to pick up the phone and speak to a key executive and have that dialogue and find out what their strategies are, where they think the market growth is going to be for them. And again, to actually be able to have that dialogue in terms of what they've done to address issues. I think we are a rather guarded society in those terms. The ability to extract information has proven relatively difficult. We could look at situations pre-crisis where institutions claimed to have risk management in place, risk structures, credit risk, rating systems, and so on. Now, if this really
the ones that you think are probably doing a good job are those that are probably open to the investing public, so to speak, and having investor relations.
I mean, financial reports are very important.
And so forth.
How quickly they're able to actually meet the reporting requirements, the type of reporting and information that's disclosed. Right. Anybody can go out there and write about risk management and say we have all of this in place, but putting it to the test is what is most important.
Okay, I'm sorry, we just have to wrap it up from